If you're watching this video, you're probably someone who's been learning ICT concepts, or you're pretty much new to it. And I've taught hundreds of students when it comes to ICT and smart money concept. One of the key questions that I get from some of the students is they understand a lot of the components of it. Understand the fair value gaps, the order blocks, the breakers, liquidity, and stuff like that, but they have a hard time when it comes to coming into charts and putting it all together in a way that makes sense and they can repeat it on a consistent day-by-day basis. And if you're someone in that situation who hasn't yet become consistent when it comes to ICT concepts, I'm about to break it down here very easily. 3 steps. First, I'm gonna break down everything that you need to know when it comes to ICT concepts, over all the different concepts and the utilizations of it. Then I'm gonna go onto your charts, creating your daily buys and simplifying your daily buys in a way that's repeatable. Third, we're gonna create a trading system. This is where we're gonna take everything that we learned and put it into a step-by-step routine that we can repeat on a consistent day-by-day basis. So by the end of this video, you're not only going to learn and truly master ICT concepts, but you're going to have a step-by-step trading plan to where you can come into markets maybe tomorrow or next week, start becoming a much more consistently profitable trader. The only thing that I ask is that you watch to the end of this video and you take notes step by step. If you miss a single step throughout this video, then it could really hurt your understanding. So just be patient and take notes. Whereas only if you get value from this video, click that like button. It takes you 1 second and it really supports the channel. If you want to become one of my students, I have released a coaching program where I help people when it comes to reaching their first payouts, making their first $5,000 or $10,000, or even becoming a full-time trader. It's gonna be a first link in the description. You can book a free call, talk to me personally. Let me see where you're at in your trading journey and how I can help you. And the first concept that we're going to be going over is the fair value gap. And there's specifically 2 iterations of a fair value gap that we want to take note of. First, we're going to be talking about the continuation fair value gaps. When it comes to fair value gaps, there's simply a middle part to a bridge. So this right here is a bridge. We have the starting point of the bridge and we have the end point of the bridge. Fair value gap is simply in the middle that connects the two. If you're taking fair value gap trades, it's important that you have an overall objective. In this case scenario, we can clearly see that we have this high point. See that the market has been in an overall uptrend, reaching back above higher and higher prices. And from this push to the upside, we can clearly see here that price creates this bullish fair value gap. Fair value gap is the separation between this first candle's high and this third candle's low. This will be referred to as a bullish fair value gap. Below it, we also have this fair value gap right here. When you're in a situation like this, when there's multiple fair value gaps and you're probably struggling to understand which fair value gap price is going to choose, it's very important to take note of that price a lot of the times will come back into the first fair value gap. Sometimes the second fair value gap or the lowest fair value gap can be a little bit more 50-50. Whenever you're in this situation, what you want to do is you want to mark out your 50%. Click on this rectangle here and go into the middle line, and this is called our consequent encroachment. 50% is a level within a fair value gap that price tends to tap into. I only mark out the 50% and take trades within the 50% if there's multiple fair value gaps. Not only it guarantees the entry, it's also a deep enough pullback where you can have a good stop loss. This is the fair value gap that we're going to take the trade in. This is where we're going to put our stop loss. So a fair value gap is a 3 candlestick formation. This first candle, second candle, and third candle right here. And our stop loss is always back below the low of that first candle. Right here is where we would put our stop loss. Simply just be reaching back above these high points. This would be our trade idea, which we can see price steps into that fair value gap. It eventually comes out into the second one, but that's completely okay. Eventually get all the way back up here. This right here would be a continuation fair value gap, where we can clearly see that price has been in an uptrend. Price comes back down into that fair value gap to find support to continue to go higher. Like I mentioned, whenever we're trading fair value gaps, we always have to have an overall objective. So since this high point was a area of what we call liquidity, which we'll talk about later on in the video, this was the objective that price was reaching back up into. So price started down here off of this reversal. The price went from lower to now higher prices. This is where the trade starts and this is where the trade ends. So the fair value gap is simply the middle area to reach back above that end point. Hope you guys understood that. Let's get into the second fair value gap. Now we're going to get into our second fair value gap, which is referred to as our inversion. When it comes to inversions, it's pretty much a reversal signature. We can see that we have a bullish fair value gap. Case scenario, you don't want to take the trade immediately as price taps into this bullish fair value gap. And the reason why is pretty simple. We can clearly see here that the market came higher to take out this original high point. Once the market took out this original high point, you can clearly see that price creates this long wick within the market, basically meaning that once price took out this high, could no longer continue going higher. You see signatures like this where price takes out an original high and immediately runs away from it. That's not necessarily bullish a lot of the time. Sometimes this could mean that a reversal is taking place. Case scenario, instead of immediately taking a trade as price taps into this bullish fair value VAG gap, want to be a little bit more patient. You can clearly see this next candlestick opens up, and this right here would be your confirmation. When the candlestick closes below the low here of that fair VAG gap, is your overall confirmation that this level is no longer being supported. Now that we know that this level is not being supported, now that we know that this bullish fair VAG gap is not being supported, can now flip our overall idea from bullish to now bearish. And instead of this being a support level, since we broke through the support level, it is now a resistance to continue going lower. So in this case scenario, as price breaks and closes, right, it has to close back below this bullish fair value gap right here at the low. We can now frame our short setup. We can put our stop loss back above this high point, reaching back below this low, as well as these lows all the way back down here. When it comes to inversion fair value gaps, unlike the regular common gap, which is a continuation, this is a reversal. When it comes to reversal trades, one of these two things has to take place. Either price takes out a level of liquidity, let's say price takes out this high, then sees a push lower, that will deem as a reversal. Or let's say there's a level of support here, price comes out into that higher time frame level of support, see a push higher, so would also deem as a reversal. None of those two things happen, then most likely this would not validate as a inversion fair value gap. When it comes to fair value gaps, there has to be context behind it. If there is no context behind it, then it's not going to work. You have to create a story of what you're anticipating to happen. Price came higher, pick out this original high point. We've seen a massive rejection to the upside, showing that it does not want to continue going higher. Following that rejection to the upside, we can see strong displacement reaching back below lower prices, breaking back below the support level. Now that I got the confirmation that price has broken back below the support level, I can now use this as resistance, see an overall reversal lower. Clearly see here that I went from, oh, this is a inversion fair value gap, to take a short, now where I'm creating a full-on story and depiction of why this should work. And this is the general context of ICT concept. Everything happens for a reason. There has to be logic behind it. It's simply not going to work. Let this play out here, and you can clearly see as it returns to that inversion fair value gap, find that level of resistance, take out that low point. Common gap would be a continuation, and an inversion fair value gap simply be a reversal signature. Next ICT concept we're going to be going over is a little popular, and you probably know of it, and that's utilizing the order block. There's a lot of different ways that people utilize the order blocks. Well, I'm about to break it out in a way that's simple to understand and makes the most sense. Like the inversion fair value gap, the order block is also a reversal signature for the most part. And like I mentioned, a reversal signature can take place between one of these two things. Either price comes lower to take out a level of liquidity and then immediately runs away from it, or price comes lower to tap into a higher time frame level of support and then run away from it. These are the two confirmations of a reversal taking place, going from higher to lower prices or lower to higher prices. In this depiction, we have to create a story. But we can clearly see here that we had this original low point, been in an overall uptrend, reaching back above higher and higher prices. And we can clearly see here that price is creating what we call a correction. It creates a pullback within the market, gather what we call liquidity. Obviously, as the market is going higher, it cannot continue going higher forever. So sometimes the market has to create a correction to gather the liquidity that it needs before continuing higher. This is what creates higher highs and higher lows. As price had taken out this liquidity, we want to see the reaction from it, and the reaction needs to be somewhat pretty sporadic. In this case scenario, you can clearly see even though we had this sporadic price action, price never took out this area of liquidity. Obviously, this would not be a valid order block setup, even though this is the last down close candle, which should be a level of support. Well, not every single last down close candle or every last up close candle is a bullish or bearish order block. Like I mentioned, when it comes to ICT concepts, you have to create a story. What makes these last down close candles different from this one right here is the overall story behind it. This is the last down close candle that came lower to take out this original low point. Once price took out this original low point, we can clearly see price created a sporadic move to the upside. Once price created a sporadic move to the upside, closes back above this high point. This right here is what we call a swing high, where this high is higher than the high to its left and the high to its right. Well, obviously, this was the last high point before seeing this drop lower. Price takes out this low point, then breaks back above this high from this liquidity sweep to what we call now a break of structure. Our price breaks back with this high, down close candle, then becomes our bullish order block. We're not just going to immediately just take a trade within this bullish order block. We want to wait for what we call confirmation. We want to see price come down into this order block and show us that it wants to find support here, basically struggling to continue to go lower. I'm gonna let this play out here. Clearly see price opens up, comes down into that order block block right there. It's into it once, twice, and then we get this strong push to the upside. This right here, as price taps into this level, did not want to continue going lower, aiding what we call rejection wicks. Rejected from it once, rejected from it twice, then off of this push higher, this is where we can then frame our long setup and adjust our stop loss back below this low point, reaching back above these most recent highs right there. You can let this trade pan out. Clearly see price ends up finding support, comes back into it twice, and we can see it continues even higher. Takes out this high, but even takes out this high right here, all the way back up here and all the way back up there, continuing that overall uptrend. So this right here would be the reversal order block, and these next last stop close candles right here would be what referred to as propulsion blocks. Basically, this is last stop close candle that reacted off of the previous order block. So this right here was the initial order block. This was the reversal order block when we took out this low, followed by this break of structure to the upside. Strong displacement came back above this original high. This validated as the order block. Price came into it, found support higher. Bam. Now we can take note of this next order block right here. This next last stop close candle, this is referred to as a propulsion block or a continuation order block. You see here that price came down into it right there, found a level of support, push higher. Bam. Taking out this original high here. Well, this next low would be called our next propulsion block right here, which you can see price comes down into it once, comes down into it twice, respects it, right? Doesn't take out the low, respects it, sees this push to the upside. You can either take the trade within the reversal order block right here or the continuation order block referred to as our propulsion block. And the emphasis remains the same. We're creating a story. Price is in an overall uptrend. We're simply going lower to gather liquidity, taking out this original low. Once price took out this low, immediately ran away from it, creating a reversal, lower to now higher prices. And then from that reversal, we took note of this last stop close candle. Came down into that last stop close candle, rejected from it once, rejected from it twice. This is the overall confirmation showing that price has found support here and it's not want to continue going lower. Off of this push to the upside, we framed along. If we miss the initial reversal setup, price creates a propulsion block, eventually comes down there, finds support, push higher, continuing that uptrend. Everything happens for a specific reason. Not taking trades based upon anything that doesn't make sense. Have to piece a story every single time before we take a trade. Before I even place a trade, I create a plan step by step by step. Where did the trade start? Where am I entering? And what frame of targeting do I have? So doing this on a consistent day-by-day basis helps you build confidence within your trading and not just taking anything, but you're taking the setups that makes the most sense, has a clear outline and plan to it. The session we're going to be going over is liquidity, and liquidity is subjective to these three things. First is session highs and lows, second is equal highs and lows, and third is prior daily highs and lows. When it comes to session highs and lows, I want you to go to your indicators tab here and I want you to search up kill zones. Specifically, you want to be using the kill zones by @Josh. Basically marks out your different session time zones. So we have the Asia session here with the bright red, and we have the London session, we have the New York AM session, and then the New York PM session, right? These are 4 specific liquidity pools that price tends to come back into every single day. Well, let's take note of the previous daily low. Using my handy dandy indicator here on the ICT HDF candles by Fadi, it takes note of my previous daily low right there. So this right here would be my previous daily low, as previous day high would be right here. So when it comes to liquidity, there's 2 specific ways that you want to look at it. This would be in the frame of a liquidity sweep, where we can clearly see price came higher to take out this Asia session high right here. During the London session, this price took out that Asia session high here. You can clearly see strong displacement to the downside. Once price took out that high, rejected from once, twice, 3 times, 4 times, basically showing that once it took out this high, it does not want to continue going higher. Obviously, as the London session opens up here around 2 a.m., 2 to 5 a.m., sees this great displacement to the downside, came back below this low, continuing lower. That would be referred to as a liquidity sweep. Price takes out area of liquidity just for it to immediately reverse in the opposing direction. It would be a liquidity run, and it's pretty simple. Liquidity run is when price takes out an area of liquidity, but instead of immediately reversing and going in the opposing direction, it continues even higher or continues lower. So this would be referred to as our liquidity run, where this was our previous daily high right here. You can clearly see that price opens up, runs back above that previous day high, then it gave a pullback. The difference between this right here to this right here is pretty simple. Price took out this high, did see this initial drop to the downside, but it did not continue to go lower. Instead, once it reached back above this original high point, price held within this range. You can see price rejected going lower once, rejected going lower twice, times, and then we see this push to the upside. Off of this signature right here, where price sees this push to the upside, pulls back into that original high point right there, and it does not want to go lower. This would then be your long setup, reaching back above this high point. So this right here would be a liquidity run. It takes out an area of liquidity, holds, within that original high point, continue going higher, this would be a liquidity sweep. Price takes out this original high, then immediately starts to reject from it. Rejects once, twice, 3 times, 4 times, does not want to go higher. And off of this break lower, you can then frame a short, your stop loss back up here, reaching just back below this low. Would be a liquidity run. This would be a liquidity sweep. The next way that you can look at liquidity is by utilizing a draw on liquidity. So like I mentioned in the first example with the fair value gap, this is a level of targeting. So we're creating a picture, right? And when it comes to creating a day bias, it's pretty simple. Where have we been? Where are we currently at? Where do we anticipate price to go next, right? This is our daily. This is how we create our story. I'm trading the New York session, which in this case would be around 8:30 to 11 a.m. EST. How I would create that bias is I have to see what has the market done previously to give me context clues where I anticipate price to go next. Right here, we can see London session had this massive drop to the downside. Following this drop to the downside, it did end up taking out this original low point right here. And once it took out that original low point right there, you can see price seeing this immediate push to the upside. This doesn't mean that a reversal is taking place just yet. So like I mentioned, taking out this area of liquidity, followed by this push to the upside, breaking back above this original high right there, liquidity sweep to this break higher, strong displacement to the upside. We want to take note of that last stop close candle right here. So bam, take note of this last stop close candle here. We can clearly see price came back into it once, twice, 3 times, does not want to go lower. Off of this push higher right there, that's our confirmation that price is finding support. So bam, utilizing our context clues, this tells us price had this massive drop to the downside, taking out this area of liquidity. We can clearly see that price is finding support within support levels. This order block is a support level. The fact that price was not willing to break back below this order block gives me a great indication price may not want to go lower, meaning that we're to anticipate possibly higher prices. Coming into the New York session here, I'm taking note of this next order block right there. And right here would be that propulsion block. Like I mentioned, this was that reversal order block. Once price took out this low, followed by this push higher, this is that propulsion order block. This is the last stop close candle tapped into that prior order block. So you can see price tapped into its level, came down into it once, twice, then we're seeing this push to the upside. Off of this push to the upside here during the New York session, price basically breaks back with this high point. We can then frame our long setup. Bam, and my stop loss back below this low. Where am I going to target? I'm going to target areas of liquidity. Since I'm anticipating higher prices, anticipating most recent highs as well as prominent areas of liquidity. Prominent areas of liquidity is referenced as session liquidity, equal highs and lows, previous day highs and lows. So my prominent area of liquidity in this case would be this London session high right here. This was the high here just as that London session opened up. This would be an area of liquidity that I would then target. Price ends up finding support, it's all the way back up there. Nice. Here, this would be our overall daily bias. Where have we been? We've been in a reversal. Price initially from the prior session had this massive drop to the downside. Once it took out this original low point, you clearly see that price struggled to continue going lower because it was not willing to break back below this last stop close candle, giving me the overall idea price is shifting from lower to now higher prices. Where are we currently at? Currently, as the New York session is about to open up, currently within this propulsion block. You can see price rejected from it once, twice, forcing this push to the upside. I see this push to the upside breaking back above this last stop close candle right here, took a setup reaching back above higher prices, because this is telling me that price action is currently bullish. The fact that price was not willing to break back below this propulsion block, you see a strong push to the upside, tells me that great momentum is coming in and we can anticipate those higher prices. Do I anticipate price to go next? I'm anticipating price to go next into prominent areas of liquidity. A prominent area of liquidity would be this London session high right here, which you can clearly see price went all the way back up there. So the key indication of when trading ICT concepts, you have to create a story. Why should price go here? Why should price go there? Why are you bullish? Why are you bearish? Right? Creating a story for what you anticipate to happen. Only take the setups that make the most sense. This setup made sense. Price was finding support. Price is in a reversal where it's struggling to break back below these support levels, currently within this propulsion block, followed by this confirmation where price was failing to break through it. We have a level of target. If you can have those 3 things in alignment, then that is a great trade. When you're coming into markets, you only want to focus on those 3 things. Where have we been? Where we're currently at, and where do we anticipate price to go next? Don't have one of those 3 things, then you're simply confused and there's probably not a setup there. When you're looking for A+ setups, look for those 3 things every single time you're coming into markets. Or price took out that London session high right here, you can clearly see price creates a reversal where after taking out the high, it creates this long wick within the markets, immediately sees this drop to the downside. And this gets us into our next concept, which is the breaker. Breaker is pretty simple. This original high point right here. Price then creates this low. Following creating this low, we create this higher high. After creating this higher high, price comes back lower to take out this low point. So from this high, lower high, this level right here, these consecutive last down close candles then become our bearish breaker right there. Bam. So that's our bearish breaker. High, low, higher high. Once price breaks back below this low point, this is our confirmation of price shifting course. And it's pretty simple because the breaker utilizes two things. It utilizes a liquidity sweep. It utilizes a confirmation. Liquidity sweep is basically from the high, low, higher high, right? Where price comes higher to take out this original high point. This basically means once price took out this high point, it could no longer continue going higher, seeing a full-on reversal lower. Utilizes a confirmation. That confirmation is the break back below this low point. You see, this last down close candle was a bullish order block. Was the last down close candle found support here, push higher. The fact that price, when it came back down into this last down close candle, did not find support, instead it broke through it, gives us the overall confirmation price is not bullish. Instead, it gives a confirmation that once price took out this high point, it's now in a reversal, going from higher to now lower prices. Here right here was once a support level, and now it's a resistance level. Obviously, we're seeing price retest it, continue going lower, as well as I can take note of this inversion fair value gap. So not only do we have the confirmation from price breaking back below these bullish fair value gaps, we also have the confirmation of price breaking back below this low point. Obviously, once price gives this retest right here, then frame my short setup, put my stop loss just back above this high point right here. Area of liquidity we can take note of is obviously this London session low. Obviously, next we have these Asia session lows, framing our picture. And see, price created that liquidity sweep during the New York session. So where we're going from is we're going from higher to now lower prices. Where are we currently at? Price is currently breaking back below this bullish fair value gap, plus price is breaking back below this last down close candle. So currently price is giving us a confirmation that price is not respecting these bullish levels, telling us that the overall order flow is shifting from higher to now lower prices. Where do I anticipate price to go next? I'm anticipating price to reach back below these low points. That's my draw on liquidity. We can clearly see here it sends up fine resistance and it gets all the way back down there. And this is the general gist of ICT concepts, keeping it simple, breaking it down, easy to understand. Went over the 3 overall PD arrays, breakers, order blocks, plus fair value gaps, the continuation fair value gap plus the reversal fair value gap, continuation propulsion block plus the reversal order block. Then we have the breaker right here. Then a lot of what we talked about was the different sessions, the London session, Asia session, the New York AM and PM session. So if I'm trading the London session, I want to be focusing on the Asia session highs and lows. As you can see, price took out this Asia session high before giving that reversal lower, back below this low point right there. In the New York session, I want to be focusing on what has the London session and the Asia session done and utilizing those liquidity pools. And then we talked about liquidity from liquidity sweeps when price came higher, took out this high point and immediately reversed from it. Then liquidity runs when price took out that previous daily high, came back lower into this same high point right there, found a level of support to continue going higher. Then we talked about draw on liquidity, basically our overall targeting. I mentioned when it comes to ICT concepts, it's a bridge from where we start, the middle, and where we end. The middle represents the PD arrays, order blocks, fair value gaps, or breakers. Point either price taps into a higher time frame, order block, fair value gap, or breaker, or price takes out a level of liquidity. Right, that's where the trade starts for that reversal to take place. And then the endpoint is our draw on liquidity, either session highs and lows, equal highs and lows, or previous daily highs and lows. And when creating a daily bias, which is the fundamental of ICT concept, where have we been, where we're currently at, and where do we anticipate price to go next. To focus on these 3 things on a consistent day-by-day basis with what I've just taught you, it makes your trading a lot more robust, right? You're not going from this to this to this to this. Every time that you come to markets and you trade with a purpose. You know exactly what you're anticipating, you know exactly where price is going next, and you're creating a story for every single time you take a trade, so it creates a high probability setup. Whereas if you want to trade live with me every single morning, as well as access to 100+ hours worth of additional education to help make you a much more consistently profitable trader, as well as weekly coaching calls, so much more that I offer for my coaching students to help them either reach their first payout, make their first $5,000 to $10,000, and we have a couple students now who have become full-time consistently profitable traders. So if you want to become one of my students, learn from me directly, get access to me personally along your journey to make it a lot easier to reach your trading goals, click the first link in the description, book a free call, talk to me personally, Let me see where you're at in your trading journey and how I can help you. I'll watch another video that goes over the most overlooked $10,000 a month strategy that I utilize on a consistent day-by-day basis. Then that video is about to pop up right now. It's one of my best videos that I made, and you'll learn a lot that you probably didn't even know. I'm your mentor, Arkhamtrades. Comment your thoughts, like, subscribe if you're new. Be safe.